Building a brand is one thing, but making it thrive, that's a whole different ballgame entirely. It takes consistency, adaptability, and a ton of resilience through the vigorous test of time. Sadly, not every business can survive that test, and that's exactly why we watch brands rise and fall time and time again with the same speed and intensity, just like the world scene with the US's largest specialty retailer. This is the story of the once cool clothing brand Gap. It all began when one man decided to solve a problem that almost everyone had faced at some point: finding jeans that actually fit. That man was Don Fisher. Right after celebrating his 40th birthday in 1969, Fisher noticed a new trend among Northern California youth. Levi Strauss & Company blue jeans were becoming astoundingly popular among the city's counterculture. Inspired by the sudden success of the Tower of Shoes, a store in Sacramento that drew crowds by offering every brand, style, and size of women's shoes, Fisher saw an opportunity. He knew that even Macy's, the biggest Levi's customer, constantly ran out of the best-selling Levi's size and colors. Fisher approached his friend, Walter Haas Jr., the president of Levi Strauss & Company, with an idea: replicate the Tower of Shoes' business model for Levi's jeans. Haas wasn't convinced, so he referred Fisher to Bud Robinson, his director of advertising, expecting a quick refusal. But Robinson loved the idea. He collaborated with Fisher and carefully worked out a legal test plan for what would become the Gap, under the condition that he would stock his store exclusively with Levi's apparel in every imaginable style and size. Fisher's wife Doris chose the name Gap to symbolize bridging the fashion gap between generations. To make shopping a breeze, everything was arranged by size, sparing customers from the ordeal of having to search the entire store to find their size. Levi's, on their part, promised the Gap would never face an empty shelf thanks to overnight restocks from their San Jose, California warehouse. Meanwhile, Robinson sweetened the deal by offering to pay 50% of the Gap's radio ads up front. To dodge any antitrust shenanigans, he offered the same marketing package to any store willing to become a Levi's only zone. With that, Fisher's first Gap store opened its doors on August 21st, 1969, near City College and Ocean Avenue, Ingleside, San Francisco. The concept was simple yet revolutionary: a store that offered a wide range of Levi's jeans, along with records and tapes to attract the younger crowds. The store was like a teenager's dream come true, featuring nothing but Levi's jeans and LP records. Teens were flipping through records with one hand and grabbing the latest pair of jeans with the other, all while trying to look effortlessly cool. The combination of trendy denim and groovy tunes created a vibe so magnetic, even the mannequins probably had dance moves. But success wasn't a straight road for the Gap. At first, nobody bought the jeans. Fisher had to resort to desperate measures, putting out ads in local newspapers offering jeans at rock-bottom prices. Slowly but surely, the store's simple but rebellious attitude started to catch on with the youth. Recognizing this, Fisher decided to incorporate the business as the Gap Inc., a nod to the much-discussed generation gap at the time. Fisher strategically expanded locations frequented by 14 to 25-year-olds, and his business model took off dramatically. The Gap focused on projecting a youthful image, which rapidly increased revenue from its target market. The store stocked only a few different types of items: jeans, shirts, and light jackets, but in all sizes and colors, ensuring customers would never leave disappointed. The strategy of offering variety with a limited range of products at low prices proved highly effective. The company's financial success was also due to its cost-efficient operations. By buying exclusively from Levi Strauss, the Gap kept expenses low. Additionally, Levi Strauss's national advertising campaign at the time provided free publicity, while the Gap enjoyed the benefits of chain store merchandising, such as centralized buying and growing name recognition. Fisher's keen sense of market trends and Robinson's innovative marketing strategies turned out to be a winning combo. In 1970, the Gap opened its second store in San Jose, marking the beginning of its expansion. The following year, in '71, the company established its corporate headquarters in Burlingame, California, starting with just 4 employees. The momentum continued, and by 1973, the Gap had over 25 locations. It had ventured into the East Coast market with a store in Echelon Mall in Voorhees, New Jersey. In 1973, the Gap made a pivotal move by ending its dependence on Levi Strauss and beginning to market other national brands along with its own private labels. This diversification paid off handsomely. By 1974, the Gap scales had skyrocketed to $97 million, a 50-fold increase, and the company was operating 186 stores across 21 states. That same year, the company also took another significant step by beginning to sell private label merchandise, further differentiating itself from other retailers. This move allowed the Gap to offer exclusive products that only reinforced its brand identity and appealed directly to its growing customer base. The growth didn't stop there. In 1976, the Gap Inc. made its first substantial public offering of 1.2 million shares. Despite going public, Don Fisher continued to retain tight control over the company's accounting, purchasing, and marketing functions. Under his leadership, the Gap had added between 50 and 80 new locations each year, establishing a nationwide presence by 1980. Now, if you know a thing or two about the fashion industry, then you'd agree that things are constantly evolving, and the jeans market in the late 70s was no exception. What started as a niche item had grown into a mainstream staple, with denim becoming a symbol of casual fashion worldwide. In response, the Gap decided to expand its clothing offerings and experiment with different strategies to meet the changing demands of its customers. Unfortunately, the Gap's attempt to break into high fashion didn't go as planned and fell flat. The company soon realized that its true strength was in casual wear. By 1980, a staggering 45% of the Gap sales were still coming from Levi's products. This made it clear that the Gap needed to forge its own identity and develop its own clothing line. To tackle this challenge head-on, Don Fisher brought in Miller Mickey Drexler as president in 1983. Drexler was a game changer. For one, he understood consumer trends and how to apply them to his business strategy. To top it off, he had recently tackled a similar challenge as an executive with Ann Taylor, and he wasted no time in launching a transformation of the Gap. With that, he helped steer the Gap towards creating its own brand of stylish yet comfortable casual wear. His vision was to shift the store's focus from catering exclusively to teenagers to appealing to those who wanted to feel young without looking rebellious. This meant creating a line of stylish, comfortable, and accessible casual wear. Implementing Drexler's plan required a significant investment, and the Gap poured substantial capital into this transformation in the first year. The immediate financial results were tough. In 1984, profits plummeted by 43% to $12.2 million. However, by the middle of '85, the gamble started to pay off. Revenue skyrocketed as customers embraced the new direction, validating Drexler's vision. With the newfound profits, the Gap strategically acquired several smaller competitors, the most notable being Banana Republic. This acquisition expanded the Gap's portfolio and allowed it to capture an even broader market segment. In 1987, the Gap decided to take its success across the pond, opening its first international store in London. The London location was a hit, and soon new Gap stores were popping up all over the UK, France, and Canada. But then the global recession of 1987 struck, and the company faced a new set of challenges. During this tough economic period, the Gap's different brands had mixed fortunes. Higher-end labels like Banana Republic and Hemisphere, a short-lived luxury brand, took huge hits. Yet the Gap's core stores continued to thrive, thanks in part to the booming popularity of Gap Kids and the revived Pottery Barn. While many companies were still struggling to stay afloat, the Gap managed to grow, proving its resilience and adaptability. Riding on the success of Gap Kids, Drexler saw another opportunity to expand. So in 1990, he introduced Baby Gap, catering to even younger customers than their parents. This move further diversified the Gap's offerings and solidified its place as a go-to brand for stylish, everyday wear for all ages. By 1991, the Gap had far exceeded the wildest expectations of its founders. Donald and Doris Fisher, the company had grown to 1,216 stores worldwide and raked in $2.5 billion in revenues and achieved a net income of $230 million. With a remarkable 40% return on equity, the Gap's performance continuously mirrored the impressive results seen in Mickey Drexler's program had taken effect. The secret of the Gap's enduring success lay in its ability to capture the hearts of the baby boom generation in the 70s with its iconic jeans and fresh image. As the generation aged and grew wealthier, the Gap adeptly followed their evolving lifestyle needs. The company expanded its offerings to include Banana Republic for more of its sophisticated tastes, Baby Gap and Gap Kids for their children, and Pottery Barn for stylish home furnishings. The Gap continued to ride the wave of youth trends in the opening of the Gap Warehouse in 1994. This new venture capitalized on the emerging idea that it was cool to be thrifty and not spend too much money on clothes. The Gap Warehouse, which would later be branded as Old Navy, offered twice as much storage space as typical Gap locations and stocked its shelves with affordable, durable clothing for all ages. The concept resonated with budget-conscious shoppers looking for style without breaking the bank. Meanwhile, Banana Republic was honing its appeal to those who still wanted to splurge on fashion. It strengthened its style offerings, targeting customers who were willing to spend more to look sophisticated and trendy. Catering to both the budget-friendly crowd with Old Navy and the upscale market with Banana Republic allowed the Gap to broaden its reach and maintain its relevance across diverse consumer segments. In 1995, Donald Fisher stepped down as CEO, and Mickey Drexler took the reins as president and CEO. Under Drexler's leadership, the Gap had grown into a retail giant, offering a diverse range of styles that could virtually meet any clothing need, whether it was for sophistication, savings, or sex appeal. Drexler spearheaded the Gap's first ventures into e-commerce, launching Gap.com, BabyGap.com, and GapKids.com, followed by online stores for Banana Republic and Old Navy. On the brick-and-mortar side, new stores were opening at an astounding rate of one per day. The company had expanded by an incredible 24,000% since 1984. But as with everything else in life, nothing lasts forever, and the 90s slowly came to an end, and so did Gap's influence on the fashion world. By the turn of the century, Gap faced challenges as its revenue growth began to slow, eventually peaking in 2005 before starting to decline. Drexler retired in 2002 and soon became CEO of J. Crew Group Incorporated. In response to the changing market dynamics, Don Fisher selected Paul Pressler, a former Walt Disney executive, to lead the company into a resurgence of popularity. Pressler managed to turn the profits from red to black, but the clothing market had become intensely competitive. It became clear that the explosive gains of Drexler's era were no longer feasible for a company of the Gap size. The early 2000s were a turbulent time for the company, marked by a revolving door of executives and lead designers trying to find the magic formula for success. Despite their best efforts, revenue continued its downward spiral. While watching the journey of the Gap so far, you don't need to be a business analyst to figure out what went wrong because it was as clear as day. The journey of Gap Inc. through the new millennium is a clear example of how complacency and an inability to adapt can spell trouble for the brand. Initially, Gap's success was due to its unique positioning, offering Brits a slice of laid-back American style that sat comfortably between the youthful allure of Topshop and the mature appeal of M&S. Its denim provided a strong alternative to Levi's, and its baby and kids wear lines offered stylish yet affordable options for parents. However, this early success led to complacency. As the fashion market evolved, adopting a fast fashion model and shifting heavily to online shopping, Gap stubbornly stuck to its old ways. The company continued to distribute the same products across markets with little variation, failing to notice the agile competitors like Primark and H&M, whose efficient supply chains and trendy affordable offerings quickly won over the younger online-savvy shoppers. The rise of sports brands crossing into fashion further eroded Gap's market share. Once the original athleisure brand, Gap couldn't compete as brands like Nike and Adidas became fashion staples. Teenagers no longer wanted to wear the same sweatshirts they'd grown up with, and as they moved on, they didn't return to the brand. Gap's response, particularly in the UK, was a destructive cycle of discounting. Constant price cuts diminished the brand's value, turning it into a retailer perpetually on sale. Customers became accustomed to waiting for the next discount email, which seemed to arrive every month. This strategy further eroded Gap's perceived worth and hastened its decline. By the end of the decade, the company's revenue had peaked in 2005 at $16 billion, only to fall consecutively over the next 4 years to $14 billion in 2009. Although there was a slight uptick in 2010 to $14.6 billion, the decline resumed the following year, with revenue dropping to $14.5 billion by 2011. The U.S. market proved particularly challenging, with competition from budget and specialty retailers chipping away at sales. In October 2011, Gap Inc. announced the closure of 189 locations, a stark indication of the changing retail landscape and the company's struggle to remain relevant. In more recent years, Gap Inc. faced another challenge when it attempted to spin off Old Navy, its largest and most successful brand. This move was seen as a way to streamline operations and focus on the brand's strengths. However, the plan was reversed in 2020 after a significant drop in sales. Today, Old Navy, once a bright spot for Gap Inc., has continued to struggle. A notable example of this is its failed attempt to revamp sizing to be more inclusive. Initially, the move was praised for its progressive approach, aiming to cater to a broader range of body types. Ultimately, the execution fell short. The brand ended up with an imbalance in inventory, carrying too many extra small and extra large items while not stocking enough inventory of the more popular middle sizes. In the end, you can say the Gap is just another brand that reminds us that we really have to evolve, to not just survive, but also to thrive.